The complete guide to qualifying for Section 1202 QSBS Tax Benefits, a startup investor's roadmap. Understanding and qualifying for Section 1202's Qualified Small Business Stock, QSBS, of the U.S. tax code benefits can seem daunting at first. This comprehensive guide walks you through every step of the process, from initial investment to final tax exclusion. Whether you're a first-time angel investor or a seasoned venture capitalist, this roadmap will help you navigate the complexities of QSBS qualification. Phase 1. Pre-investment due diligence. Step 1. Verify basic corporate eligibility before investing a single dollar. Confirm that the target company meets the fundamental requirements outlined in Section 1202(d). First, ensure the company is a domestic C corporation. This might seem obvious, but many startups begin as LLCs or S corporations. Request and review. Certificate of Incorporation IRS Form 8832. If the company converted from an LLC, all corporate governance documents. Case study. The costly conversion mistake. In 2018, an angel investor invested $500,000 in a promising AI startup, assuming it was a C corporation. The company was actually an LLC that hadn't completed its C corporation conversion. When the company was acquired 3 years later, the investor discovered they couldn't claim the Section 1202 exclusion. Always verify corporate status before investing. Step 2. Asset test verification. Under Section 1202(d), 1(a), and (b), the company's aggregate gross assets must not have exceeded $50 million before your investment and immediately afterward. Request. Current balance sheet, historical financial statements, cap table and recent valuations, documentation of any outstanding commitments or options. Pro tip. Remember that Section 1202(d) 2 specifies that aggregate gross assets includes cash plus the adjusted basis of other property. Market value of intellectual property often exceeds its basis, so a company could be worth more than $50 million while still qualifying. Phase 2. Investment structure. Step 3. Original issuance requirement. Section 1202(c)(1)(b) mandates that you acquire the stock at original issuance. Document your investment with Stock Purchase Agreement, Board resolutions approving the issuance, evidence of payment, updated cap table showing your ownership. Watch out! Secondary purchases from other shareholders don't qualify. If you're participating in a larger financing round, ensure your shares come directly from the company. Step 4. Consideration type per Section 1202(c)(1)(b), i.e., your investment must be made with money, other property, not including stock, services, excluding underwriting services. Document the exact nature of your consideration and maintain records of wire transfers or checks, property transfer agreements, service agreements. If applicable, case study. The services track. A startup advisor received shares for past consulting work but failed to document the specific services provided. During an IRS audit, they couldn't prove the shares weren't received for underwriting services, jeopardizing their QSBS status. Phase 3. Ongoing monitoring. Step 5. Active business requirement tracking. Section 1202(e) requires that at least 80% of the corporation's assets be used in the active conduct of qualified trades or businesses. Regularly request quarterly financial statements, asset utilization reports, business activity summaries, R&D spending documentation. Create a monitoring checklist covering prohibited activities under Section 1202(e)(3), professional services, banking, insurance, financing, farming, natural resource businesses, hospitality operations. Pro tip. Working capital and research assets can count toward the 80% requirement under Section 1202(e)(6), but watch the 2-year limitation. Step 6. Stock redemption monitoring under Section 1202(c)(3). Watch for disqualifying redemptions from you or related persons, 4-year period, significant redemptions exceeding 5% of value, 2-year period. Request regular updates on stock buybacks, redemption programs, related party transactions. Phase 4. Holding period management. Step 7. 5-year holding period tracking. Section 1202(a)(1) requires a 5-year holding period. Create a system to track original purchase date, any subsequent transfers or reorganizations, tracking periods from Section 1202(h) transfers. Case study. The reorganization reset. An investor nearly reset their holding period during a company reorganization but saved it by structuring the transaction under Section 1202(h)(4), which preserved the original acquisition date. Phase 5. Exit planning. Step 8. Gain limitation analysis. Calculate your maximum exclusion under Section 1202(b)(1). $10 million lifetime limit per issuer, 10 times your adjusted basis in the stock disposed of during the year. Required documentation. Original investment records. Basis calculations. Previous QSBS gain exclusions. Step 9. Exit structure optimization. If approaching exit, analyze impact of different exit structures on QSBS qualification. Treatment of earnouts or contingent payments. Application of Section 1202(h) for tax-free reorganizations. Phase 6. Tax reporting. Step 10. Final documentation package. Prepare a comprehensive file containing original qualification evidence, ongoing compliance documentation, exit transaction documents, gain calculations, supporting legal opinions. Pro tip. Consider obtaining a tax opinion letter from qualified counsel before claiming the exclusion. Common pitfalls and how to avoid them. 1. The multiple class problem. Some investors lose QSBS status by receiving preferred stock with terms that effectively create a second class of stock. Ensure all stock rights are carefully reviewed. 2. The working capital trap. Companies holding too much cash can fail the active business requirement. Help portfolio companies develop and document plans for working capital under Section 1202(e)(6). 3. The service business challenge. Many modern startups blend technology and services. Document how the company's activities fall outside the prohibited service categories under Section 1202(e)(3). Conclusion. Successfully claiming the Section 1202 QSBS exclusion requires careful planning from day one. Create a compliance checklist based on this guide and review it quarterly. Consider working with experienced counsel, especially for larger investments. The potential tax savings make the effort worthwhile. A completely excluded $10 million gain could save millions in federal taxes. Remember, documentation is key. In the words of one tax court judge, a taxpayer's memory is no match for contemporaneous records. Start your documentation process before making your investment and maintain it diligently throughout your holding period. Disclaimer. This is purely tax information and not advice. Please consult your tax professional or tax Dosti team at taxdosti.com. Thanks.